Every time you deposit money, swipe a card, or take out a loan, your bank may be making money from that exact activity. But how? And what exactly are you paying for without even realizing it? Welcome to this Vision Ledger Explainer. Today, we're diving deep into the hidden machinery of how banks actually make their money. We're going to look at everything from everyday loans and credit cards to sneaky hidden fees and the massive engine known as the interest rate spread.
So, what are you actually paying for? Well, to figure this out, we need to understand that banks don't just take your deposit, smile, and lock your cash away in some dusty, guarded vault. They are highly optimized businesses. To really uncover the central mystery of their business model, let's follow a fictional, everyday American customer. We'll call her Sarah. We're going to follow Sarah on her typical journey through the banking system. By watching how she interacts with her bank, we can see the exact step-by-step process these institutions use to turn our everyday financial habits into literally billions of dollars in revenue.
Okay, so Sarah's journey usually involves 3 foundational steps, right? First, opening a checking account for her paychecks, getting a credit card for daily expenses, and eventually taking out a loan for a major purchase. Actually, let's start with that last step, the loan, because honestly, this is the absolute biggest engine for banking revenue. It's the most straightforward way banks make their money, and it really sets the stage for everything else they do.
Let's say Sarah decides she wants to buy a car, so she takes out a $20,000 auto loan. As the borrower, she gets access to that cash immediately, meaning she can drive her new vehicle right off the lot. That's exactly what she wants. But in return, she agrees to repay that principal amount plus a percentage of interest over, let's say, 5 years. By the time Sarah actually pays off the car, she hasn't just paid 20 grand, she's paid thousands more in interest. Now multiply Sarah's single loan across millions of everyday borrowers, buying cars, funding home renovations, or paying for college. You can quickly see how interest income becomes a massive multi-billion-dollar revenue stream for the bank.
Moving on to our next stop, credit cards. Now, if Sarah treats her credit card just like cash and pays her balance in full by the due date every single month, she essentially borrows the bank's money for free. No harm, no foul. But here is where it gets interesting for the bank. When customers carry balances month to month, what we call expensive revolving debt, that's when steep interest charges kick in. And with rates that frequently hover around 20% or even higher, this revolving debt is an incredibly lucrative goldmine for card issuers. It literally transforms a simple payment tool into a massive profit center.
Now, beyond interest, there's another huge stream of revenue, and it's one we all know a little too well: account and service fees. Think about the everyday traps. You've got monthly maintenance fees that trigger if your balance dips just a little too low. Overdraft fees if you accidentally spend a few dollars more than you actually have. Or my personal favorite, that frustrating fee for simply using an out-of-network ATM to get your own cash. I mean, you might look at a $3 ATM charge and think, no big deal. But when a bank collects those $3 from millions of customers every single day, those tiny annoyances add up to a staggering amount of annual corporate revenue. It's basically death by 1,000 cuts for the consumer, but a river of cash for the bank.
But right here is where we hit probably the biggest misconception in all of personal finance. Let's say Sarah gets her monthly paycheck and deposits $10,000 into her checking account. The bank does not just take her specific $10,000 deposit and put it into a personalized, heavily guarded box with her name on it in a backroom vault. Nope. This is the part most people never even think about.
The crucial truth is this: your deposits equal bank funding. Your money is the hidden engine powering the entire banking system. Under a concept known as fractional reserve banking, and of course subject to strict regulations and capital requirements, banks actively use the funding from your deposits to finance their lending activities. Remember Sarah's $20,000 auto loan? Well, the bank was able to fund that loan, at least in part, using the deposits of other customers. Your idle cash is incredibly valuable to them. It's actively working behind the scenes to generate loans and interest even when you aren't paying a single fee on your account.
And this brings us to a really foundational banking concept called the interest rate spread. Imagine a 3% rate represents the bank's average funding costs. Basically, this is the yield they might pay out to depositors, like Sarah, as a reward for keeping her emergency fund in their savings accounts. The bank is essentially paying a small fee to borrow her money so they can use it elsewhere.
But now I want you to immediately contrast that 3% payout with a 7% rate. This higher percentage represents what the bank earns on its interest-earning assets, like the interest they charge on mortgages, business loans, and, you guessed it, Sarah's auto loan. So they're paying out a little bit to get the money and charging a whole lot more when they lend it out.
The difference between those two numbers is called net interest income. In our example, it's that 4 percentage point spread earned when a bank makes more from its interest-earning assets, the 7%, than it pays for its interest-bearing funding, the 3%. Now, to be fair, I should clarify that this 4% spread isn't just pure, unadulterated profit. Out of that spread, the bank still has to pay for its thousands of employees, upgrade cybersecurity tech, keep the physical branch lights on, and cover inevitable credit losses. But make no mistake, this spread is the undisputed core of how banks operate and generate their foundational wealth.
So you might be looking at all this and thinking, wait a minute, my checking account is completely free, I never pay overdraft or ATM fees, how does a free account benefit the bank at all? Well, here's where it gets really interesting. A free product is essentially a gateway. First off, it provides the bank with those stable deposits they desperately need for funding. Second, it serves as the entry point to a much broader, highly profitable relationship. Free checking absolutely does not mean the bank receives zero economic value from you.
Think about it like an ecosystem. A single customer, like Sarah, with just a checking account, only generates a pretty small sliver of revenue. But what if she opens that checking account, eventually signs up for their rewards credit card, later takes out an auto loan, and finally trusts them with a massive 30-year mortgage? Suddenly, she's generating revenue across multiple different products. This is exactly why financial institutions fiercely compete, often offering you literal cash bonuses just to become your primary bank. The longer the relationship and the more products you use, the vastly more valuable you become to their bottom line.
Now, before we wrap this up, it's incredibly important to remember that the interest banks charge isn't just free money raining down from the sky. Banks take on severe risks to earn this revenue. They face credit risk, which is the very real chance that borrowers lose their jobs and completely default on their loans. They also have to actively manage liquidity risk, interest rate risk when global market rates shift unexpectedly, operational risk, and massive regulatory compliance costs. A good chunk of the revenue they generate simply compensates the institution for managing these complex risks, making sure the financial system doesn't collapse and the services you rely on keep running smoothly.
So what does all this hidden machinery actually mean for you? Well, understanding this business model is your greatest weapon in making smarter personal finance decisions. It means you absolutely must actively review your statements and understand exactly what triggers your account fees so you can avoid them. It means you should be shopping around to compare savings interest rates because, hey, banks desperately need your deposits and you deserve to be compensated fairly for them. It also means avoiding high-interest revolving debt at all costs. You always have to look at the total cost of a loan, not just the monthly payment. And finally, never blindly accept a financial product simply because your bank recommends it. Yes, you are their customer, but remember, you are also their revenue stream.
The next time you open your banking app, I challenge you, don't just look at your balance. Look at the business behind it and ask yourself, is my money working harder for me or for my bank? Understanding how they make money really is the first step to keeping more of your own. If you found this explainer useful, make sure to subscribe to Vision Ledger for more clear, structured financial breakdowns. And I really want to hear from you. Comment below and let me know, which complex banking topic should we explain next? Thanks so much for learning with me today.